Well, good afternoon, everybody. Tim Fuller is my name, and I'm the Head of Operations for Nucleus Wealth. Thanks for tuning in. We've got a fantastic webinar ahead today entitled International Investment, How to Learn to Invest Like the Professional. I'll just kick off just with a quick disclaimer. Obviously, anything spoken about today is of a general nature, and we do thoroughly recommend that you consult a professional or you're a financial advisor before taking any of these themes discussed today into practice. So jumping in. So our first speaker today is David Llewellyn-Smith. Besides co-authoring The Great Crash of 2008 with Ross Garnaut, he has in the past launched and sold a very successful magazine, was also the chief economics editor for that magazine called The Diplomat magazine. And at the moment, he's presently the chief editor for the highly read macro business blog, and we recommend swinging over there at some stage if you want to see more about David's day job. So with no further ado, I'll hand over to David. Thank you.
Thanks very much, Tim, and welcome everybody. I'm just going to quickly describe a few of the reasons why it makes sense to look at international shares at the moment, largely from the perspective of the currency. But just diving straight in, the first reason it's useful to be looking at international shares today is if you're not doing it, you're artificially limiting yourself to only 2.5% of the world's stocks. You know, in times of high correlation, that's not necessarily going to be a problem. But when we're going through a period like we are now, where something's gone awry with the ASX, then your returns are going to be pretty kaput. The reason why things are a bit difficult for the ASX right now is pretty much related to the underlying struggle with the nominal economy in Australia. We think that's got a number of years yet to run. It's related to China slowing, falling commodity prices, difficulties with governance in Canberra, where we're having trouble getting anything done, and I think soon, probably deleveraging in households as well. So there's no end in sight to the difficulty in nominal growth in Australia. That means it's very difficult for firms to grow profits on the ASX outside of either M&A or building a better mousetrap. And given banks and miners dominate the bourse, we're not likely to see much of the latter. If we just move forward to a chart here, we can see this in the outlook for EPS growth around the world, and you can see here that Australia has been lagging for a number of years, and there's no forecast change to that for next year either. So that's reason one. Reason number two to think about international shares is that the AUD, the Australian dollar, can be your friend, both in terms of exaggerating gains and helping cushion losses, or it is something of a natural hedge. This is particularly the case when it comes to the US dollar, given Wall Street tends to lead global stock rallies and the US dollar to rise behind that. It can be quite useful in terms of adding to your gains, and at the same time, it's a safe haven currency and can be also helpful, therefore, on the downside, limiting losses. It's not quite so clear, that relationship, in terms of other currencies, but the US dollar one can be very favourable. The third reason to consider offshore stocks at the moment with reference to the currency is that we think in cyclical terms that the Australian dollar is still likely to fall a long way yet, even though it's come down some way from the mining boom peaks. Our working model for the fair value of the currency still has it as quite expensive. We use 5 variables to assess that value. The major one is actually the terms of trade, which I'll show you in the next slide. and you can see the blue line here is the terms of trade, which is the ratio of export prices to import prices. And currency, which is represented here by the trade-weighted index, follows this reasonably closely. And basically what this is rising and falling commodity prices and the currency chasing them. So, we think, given that the terms of trade and currency and commodity prices are still higher than they've ever been at any other point in history, that the odds favour them still falling a long way yet, and the currency going down with them. The second variable on the currency that we look at is relative growth prospects. And so, jurisdictions with higher growth outlooks tend to do better with their currencies. And as described before, the Australian nominal economy is going to struggle for some years yet. Thirdly, interest rates, play a role. And, with the Fed likely to hike well before the RBA does, that's going to be favourable for further AD falls as well. Technicals play a role with the currency, but at the moment actually they look pretty bullish, but that's rather short term. And then finally, you've got to look at the other side of the whichever currency pair you're examining. And in the case of the US dollar at the moment, it's very positive for further gains. The US has a very tight labour market, a tightening Fed, tax reform, which includes some repatriation provisions, which will force corporations to bring a lot of money home, which is very bullish. And those are growth tailwinds that should favour the US. So just wrapping up on the currency, those are the kind of structural reasons why you can think about going offshore at the moment. I'll give you a quick wrap on my cyclical assessment of what's coming next year. Europe, we think, is probably going to slow from what's been a reasonable recovery. It's well behind the US in terms of improvement in the labour market and unemployment coming down, and the ECB is likely to be long behind the Fed. There's also the breakup risks that kind of dog Europe eternally around Catalonia and Italy. China we expect to slow as well. It's been through another credit boom for the last 2 years, which has driven big property market gains in construction, with infrastructure too. But credit there has been slowing for 6 months. The property market's definitely slowing, and we think that'll continue in 2018. Certainly no crash of any kind in prospect, but clear slowing. That will likely drag down commodity prices, which are heavily associated with emerging markets. So we think that those will also come off. So that leaves you the US. We think that's the bullish story for 2018, as already described. So thanks very much for listening, and I'll pass you on to Damien Klassen now to talk about what you might invest in.
Thanks, David. So today we've run through the why you would want to be investing in international equities. I'm then going to deal more about what you should be investing in and what your options are. So I've sort of got a bit of a history up there on that. I'll sort of let people have a read through that and look at that when we send out the slide deck. And I'll jump straight into the actual presentation. So there's three things I really want to deal with. First, the most common indices or indexes that you can invest in. What's the differences between the Australian market and international? So once you are going to drift overshore, what extra options do you have? And then finally, some research, some places you can get research, and the types of things you should be looking for that's different to the Australian market. So the most common thing people say to me is, look, I'm looking to invest offshore. I'm just going to buy an index. As you can see from this graph, the number of indexes has increased dramatically over recent years. So especially with the rise of exchange traded funds, we actually now, this is showing for large cap international stocks. There's about 4,000 odd under Bloomberg's measure, and we've got about 5,000 indexes over those same stocks. So now in many markets, there are more indexes than what you have actual stocks to invest in. So just as confusing, how do you choose the index that you actually want to invest in, and you don't end up in the wrong one? So the most common indexes you'll see are size-based indexes. So a size-based index is basically weighted by the value of all the shares that are owned within that index. So MSCI, FTSE, and S&P are the three biggest providers of international ones. MSCI tends to be the most commonly used for the world indices. But keep in mind that when we're size weighting, because we're reflecting the weight of money, these are targeted to large fund managers. So if you're running a 50 or a billion or a $100 billion fund, you're limited as to what stocks you can buy. Your stocks need to have a certain amount of liquidity. They need to be big enough for you to actually buy a meaningful stake in them. You can't be investing in sort of $10 and $20 million stocks. And so that's what these indices are designed to provide, and that may not be appropriate for you. So the MSCI World Index is probably the preeminent one. About 1,600 stocks and 70 odd Aussie stocks within that. That's only developed countries. You can then add the same. If you look at the same size stocks, you can add emerging markets, and you get another 800 odd stocks. That often goes, the combination of those two often goes under the mysterious name of the ACWI. So MSCI ACWI is what people often call the mixture of those. And then to add one more acronym to it, they also have an IWI, which is an investable index. And that's sort of there's 8,500 stocks within that, and that sort of equates back to the ASX 200. Keep in mind, though, that these are large and mid-cap stocks. The ASX has about 10 times as many stocks that's actually listed, and there is about 10 times as many stocks out there in other markets. But they are a lot harder to access if you want to start to get into some of the smaller caps, and often the trading cost will be quite high if you're trying to get into those ones. So, but if you're looking to buy funds or exchanges, sort of broad-based ones, that's the type of they're the type of indexes that you want to be looking at. Then you can go into some of the individual ones that you get to markets. Two things just to note quickly with the ones that I've got shown up on screen. Firstly, the US S&P 500 and the UK FTSE 100 are both pretty much full of international stocks. So while they are listed on the US and they are the 500 biggest US stocks, when you're buying things like Apple, Google, McDonald's, those types of stocks, you are getting stocks that have got a broad international exposure. They're not particularly a US exposure. If you want to dig back into the more US stocks, the most common one people look at is the Russell 2000, which is basically all the stocks between 1,000 in size and 3,000 in size. So it's smaller cap stocks, still very large relative to what you see in the Australian market, but you get a more direct US exposure. And then finally, the Dow and the Nikkei. Too much to go into now, but they're actually not really investable, what you call investable indexes. Flipping to the emerging markets is the next most common one. People say, well, I want to invest in emerging markets. I want to try and get some growth and find some of these exciting companies that are growing in China and India and places like that. The thing I wanted to note with this graph, which is the weights of the ACWI index, so basically the developed and the emerging markets together, is that the GDP of China is closing in in the GDP of US, so it's getting close in size depending upon how you want to measure the currencies. Graph, you can see that China is only 3% of the world index compared to sort of over 50% in terms of the US. You also notice that that France and Germany, which are both large economies, aren't particularly big in terms of their weights within that index. And also, if you want to start drifting into emerging markets, you need to note that the corporate governance isn't the same in these countries. So you get the strong relationships between companies and governments, and they rely on particular licensing and things like that. If you get stocks which are, say, Gazprom within Russia, the question there is, how much of its strategy is driven internally and how much of its strategy is driven from politics. So within emerging markets, there are lots of different things. The other thing is, if you're going to buy an index of emerging markets, you need to realize that you will get a lot of Russian energy in that index, which you may not have been expecting. You may end up with a lot of Chinese state-owned entities. So I think a lot of people chase emerging markets trying to find these growth stocks. I think when they're looking for that growth stocks, they probably weren't looking for the Chinese state-owned entities within that. So so knowing what you're buying and what's actually within that index is very important. That sort of leads on to the most common thing people would look at is okay, I'm chasing emerging markets. I think they're cheaper than world markets and they're growing faster. And I'm going to pick on the ratio I've got up on screen here. These are a bunch of valuation ratios. The one I'm showing here is the next 12 months price to earnings ratio. So you can see that and so it's basically the price of the stock divided by the earnings that the stock makes over the next 12 months. So the forecast earnings is what the NTM means within that. So you can see that the world index at 16.2 is about 10% higher than the emerging markets. So yes, I can buy emerging market stocks and buy them at a cheaper rate than international. The thing with that is that does contain a lot of these ones that are on low PEs. Things like the Chinese state-owned entities in particular. So a lot of people talk about the healthcare as being a great spot to get into. I want to get into emerging market healthcare as people within China and India. There's a growing middle class, and these people will start being able to afford better healthcare, and they'll be able to afford to have ear implants if they're deaf, or afford to have their sight fixed if they've got sight problems, things that they might not have been able to afford otherwise. The issue with that is that there's a lot of other investors who've also picked up on that same theme. So if I look at the emerging markets, this middle column I've slotted in now, the healthcare within emerging markets, you can see that that's actually trading at about almost double the emerging markets itself and well above the market levels itself. So there are popular themes out there. Some of those will be very successful, but it is important to mix not only whether these things are going to grow and whether they're high quality investments with how much you're actually paying for that to get that investment, and whether that's a theme which a lot of other investors have caught on as well. In that thousands and thousands of strategies, you'll also notice there's a whole bunch of these other names which will crop up from time to time. You'll see things like value strategies. So they're basically buying stocks that are cheap. Quality strategies, which are buying things which are earning good returns and usually quite stable. And then finally growth, which often is just whatever's left over within the market. The issue with a lot of those ones is, in particular, the quality index, is you'll find that that's largely based, depending upon who does it, but it's largely based on a return on equity. These are very mechanical types of index constructions, and you will find that stocks within that, as accounting standards have changed, you're not quite getting the same stocks you were 10 or 20 years ago. The new accounting standards tend to encourage more write-downs and not writing assets back up. And so what that means is if you get some asset write-downs, which makes, but it's a fake quality. And then there's a bunch of these other smart beta, whether you're looking at buying stocks that have a low volatility, high dividend yields. You can equally weight stocks. You can get currency hedged, or you can look for these the ESG, the environmental, social, or corporate governance type stocks. Once you've then gone, especially if you're looking to invest in some stocks directly, and you want to invest overseas, it's important to then get stocks that are going to be different. Within Australia, the banking sector is about a third of the index, of the large cap index. It's less than 10% internationally. It's also worth noticing you are getting very different banks. Within Australia, there's an argument. You've got a 1 in 4 chance of picking the good performer amongst the top banks. The US has thousands of banks. A lot of those banks are very simple. They lend money, they take deposits, and then you get some very complex ones. So things like Goldman Sachs or Morgan Stanley that are investment banks rather than traditional banks. So you are looking at a very different market. The Aussie REITs and miners, the ASX has got a lot of these. There's basically 3 times as many REITs on the Australian market as what you'll see in a typical world market. There's about 10 times as many mining stocks. So especially in mining, you just need to consider, look, do I really need mining offshore if there's lots of it locally? Some of the other sectors you can pick up over there, software and IT. You're talking almost 20% of the world market with these two added together. This is your Googles and your Microsofts and your Apples. It is worth noting, once you started to dig into some of the other stocks within that, though, is that you can get some very different stocks. So the semiconductors in particular is a big part of that market. Names like Intel, Applied Materials, or Qualcomm. Often they have very high capex requirements and a rapid development cycles. You know, they've got the latest and greatest chip, and so they're on a run for the next couple of years as being the leading one. But they need to come out with the next hit, and otherwise their their earnings and margins will drop back significantly if they don't keep coming up with those hits. So they are sort of very high capex plays. And it's also worth noting there's stocks within that, things like Nokia or BlackBerry, extremely successful handset makers, which only took a few years to go from being premier products to an afterthought. In terms of oil and gas, worth noting there, as it's on the slide, the ASX, you get very much gas. In the world, it's more oil, and often you get some stocks that are quite integrated. Oil makes up a big part of that. So stocks that do chemicals and refining and oil exploration. The auto sector largely non-existent in Australia, so worth having a dig into that. A lot of those stocks went broke a few years ago, and so there's still some stigma attached to those. They're very cheap, a lot of that sector. You can pick them up for sort of 10 times earnings or below. Having said that, though, a number of them do also have large pension liabilities that sort of sit off balance sheet. And so digging into the weeds on these things is important, because they aren't the same as some of the stocks you will see within Australia, and they might have different requirements and different off balance sheet liabilities. And the last one there, the consumer products and food and beverages, a lot of the big Australian brands have been bought over the last sort of 10, 20 years. And so it is one area, if you're looking to access to Colgate's or Kellogg's or various chocolate manufacturers or whatever, you generally do have to go and look at international stocks to get that type of exposure. On the research front, I've got a whole bunch of stocks up here that you might be interested. Sorry, a whole bunch of areas which will give you information. It is worth noting that there's sort of three big research providers: Thomson Reuters, FactSet, and S&P Capital IQ. Generally tend to provide data to a lot of the other ones. So Yahoo Finance and Google Finance will get their data from those ones. And there's a number of different places you can get your research from. If you do want to get your research from brokers, do remember that you're not their main client. You're sort of a bit of an afterthought. And their main clients are, first of all, corporates who they're raising money for. So there is a predisposition for positive research reports. And secondly, institutional investors who don't really pay attention to broker recommendations. They look at their numbers and look at the research behind it, but the actual recommendation as a buy, sell, or a hold is pretty much ignored by most institutional investors. So investing in international, you're going to need this research process. Basically, human beings are very good at catering to pre-existing biases. We see more and more as Facebook rises and people and internet websites that people read things that give them confirmation bias. So, and the same thing applies to international. You've got this broad suite of stocks. There's enough stocks out there that are going to give you something to confirm your pre-existing biases. You're going to need a research process that gets out and actually challenges those biases. So these are 4 things I think you're going to need within your research process: something to look at quality of stocks. So how good is the stock I'm buying? Something to look at the growth in terms of the growth rates, and remembering that human beings aren't particularly good at predicting growth. And then how do you establish value as important as just as important as those above two? I need to find, so once you've found a stock you like and it's growing strongly, not overpaying for it is extremely important. The last one's a bit optional. Trading metrics. Some people like to look at those, some people like to ignore them. But within your research process, having those top 3 is absolutely critical. So what I do within mine, I generally start with quant. So I start with the MSCI World, 1,600 stocks. I try and remove out any stocks that are low quality or expensive. And I then get analysts to go through and do detailed assessments, and I sort of give them targets to say, why does my quantitative model like this particular stock? Now we need to go in and find out if that's true or not, and vice versa on things it dislikes. And finally, removing some of the macro risks and things like that. So I put every stock I've got, I put onto this quality value matrix. So I want cheap stocks in the bottom left, and cheap stocks are on the left, and high quality stocks are in the bottom. I then look to try and buy stocks that are below that green line. So trying to find stocks that are both cheap and high quality. And I use this model very much as a guide, not as gospel. I think any model, you need to recognize that there will be problems within it. But the idea behind this is that I really do want to find stocks that are, I really do want to use my model to challenge my assumptions. And if stocks are rising, I bought this stock because it was cheap, it's up 20%. It's very easy to get caught away with the excitement and stick with it rather than letting your model tell you, well, now it is, you bought it because it was cheap, now it's not cheap. You need to sell it and move on to the next stock. So I'll leave these just as to be read. So the types of things I'll look at for quality are the sort of all the Warren Buffettisms, economic moats, and how fast stocks are growing, and how stable their earnings are, whether their interest and debt is actually appropriate to the type of company it is. So those things all sort of go into that quality score. I'll then have a value score, which will look at a whole bunch of different measures, whether it's cash flow, which tends to be a bit more comparable between international companies, earnings, sort of trying to measure pre and post abnormals, and also cater for differences in accounting standards, looking at balance sheets, and finally the returns that you actually get. Whether it's, you tend to find Australian stocks like to give high dividends to take advantage of franking credits. You find a lot of stocks overseas don't pay as high dividends, but they do quite high buybacks and capital returns. So what you might find is that while in Australia you might get a 3 or 4% yield from a stock paying back dividends, a US stock might pay you 2% as a yield, but then it actually buys back 2% of its stock, and so you sort of get 2% extra capital appreciation from that, largely for tax reasons. So the last bit, the most common pitfalls to look for, false positives and negatives, whichever site or research method you use. If you're looking at international stocks, you tend to have quantitative methods to look across a broad range. You are going to get a lot of false positives and negatives. It all comes back to not having this blind allegiance to what your model's telling you. You need to use that model to challenge your preconceptions, not to sort of drive the end results, regardless of the outcome. The accounting side of it, it is worth noting that there are differences. They're a lot less than they used to be, but there's a US GAAP reporting, and there's an international financial standard which most other countries use. Having said that, though, as well, there are some differences between the countries on international accounting standards, and Japan in particular is one of the ones that's most different. Some of your long-term trends. If you are picking strategies or indexes based on long-term trends, it's worth noting why it's actually been a successful strategy. So one of the examples I use is low volatility stocks and high yield stocks have sort of had a good 20, 30 years of performance. A lot of that's been because interest rates have been falling over that time. So we've sort of seen interest rates come down from 15, 20% to basically zero in most international countries. So if you're basing a strategy on low volatility or high yield, you need to just make sure that make sure you're comfortable with how much of that has been because interest rates have been falling and how much has it been because that's actually generally a good strategy. And the last thing is value traps. If it looks too good to be true, often it's going to be. You'll find plenty of stocks that look cheap. Then the next thing you find, the earnings halve and the share price halves, and it still looks cheap. And you're back to square one. But that's the types of things. That's how I sort of tend to look at the stocks that go into the portfolios that Nucleus runs. We'll go through those steps, and hopefully that gives you a decent insight as to how you can do it. And I'll hand over now to Tim to run through the actual how to invest.
No problems. Thank you. Thanks very much, Damien. So obviously we've had the why invest overseas with David, what to invest in with Damien, and now it's up to myself with how. So how do you look to move money overseas and invest in some of the themes covered in today's webinar? I'll just quickly, I won't go through my experiences in the space, but whilst I count myself as fairly experienced in the personal finance game, I'm not so much in the webinar, and I'm sorry about that quick sneak peek of Nucleus webinar HQ at the start there. But anyway, we're moving on. So look, I guess breaking it down to nuts and bolts, you've really got a couple of different pathways ahead of you. So look, you can choose your own stocks, do your own research and choose your own stocks. You can have it professionally managed. Or more often than not, I find, it's sometimes not a bad place to start is somewhere in the middle. So, choosing a mix of either or in which to really suit the amount of time you've got to invest in this. And as you can see, there's a huge amount of things to think about, but also budget in terms of what you're willing to spend on particularly either advice or also investment management as well. But we'll talk about that in a minute. So I guess the first two there, so the self-managed portfolio and the professional management sort of fork in the road, so to speak. So what we'll do is we'll turn left and we'll go down the self-managed path in choosing your own stocks and just have a look quickly at some of the easiest ways to do that. Certainly, of course, something that jumps to mind, as you've probably had a lot of experience in, is using online brokers. And typically, it's not a bad place to start. So what I've done is we've got a little snapshot of the offerings for international investing through some of the major online brokers there. As you can see, it's quite varied. Certainly in the past, investing overseas was really quite difficult to do and fairly involved. And I think particularly the big four broking houses or broking houses attached to the big four banks are coming on board with the idea that we need to make this easier for clients to do that. So thankfully that's the case. You do need to be a little bit careful though, where as I put the red box up there. So certainly a couple of the big banks and certainly some of the sort of other investment providers are getting quite competitive for the US market. You do need to be a little bit cautious though that if you are choosing one, that what are they charging for investments in some of the other parts of the world as well. So there seems to be a bit of an arms race on getting the best US sort of trading costs. But you do need to sort of think, well, if I want to look outside of the US, how much is that going to cost me as well? Obviously, brokerage is a big one here, and typically with most investment platforms for your stocks, there's no ongoing cost. There might be an account keeping fee or something like that. So really, it comes down to brokerage. And what we've done is just sort of grabbed a portfolio of 20 US domiciled stocks that are actually in our portfolios, in our international portfolios at the moment. And just sort of used an example there of someone looking to invest 100,000. Now this might be, the international component of a self-managed super fund, quite common. And saying, well, look, if I've got 5,000, if we've got 20 stocks at 100,000, 5,000 each. And then just sort of working out, well, from a brokerage standpoint, be looking at around 300 from the cheaper end of the list before to around 1,200 in brokerage. I suppose the key thing to think about there is that the initial brokerage is one thing, and it's of course always important to get a good deal there. But then you need to look at, well, what if I, for example, had a couple of $1,000s that I wanted to tip in, make it 102? Am I going to be buying, am I going to be overweighting in one stock in particular, or, am I going to be buying the lot to sort of keep the balance within the portfolio? And this is where the sort of having a fixed cost for brokerage can not be as beneficial for you, given the fact that if you went and bought 20 stocks, and paying the minimum brokerage, you probably wouldn't have a whole lot left of your $2,000 or your $5,000 that you wanted to tip in. So that's certainly one limitation of going down the broker path. But what we'll do is we'll run through a few pros and cons as well. So of course, obviously you're doing it yourself, plenty of control, and of course transparency. You're seeing everything that's in there. With individual ownership, of course, comes the individual ownership of any proceeds from those investments, distributions and dividends, of course. But of course, on the other side of the coin, you're looking now at needing to run the portfolio like a professional manager. So you need to put the research in. You need the oversight and plenty of time to look at that. And look, for those that have, no doubt there's people out there today that are managing Australian share portfolios, would be very mindful of this. And then now extending that amount of prowess to the rest of the world might seem like a bit of a daunting task. Outside of actually managing the companies themselves, I guess then you need to extend your knowledge of world events and the political regimes as they change around the world and how that reflects on your portfolio. And I guess as the final con, it's really having a more or potentially more complex tax situation as you, particularly if you're doing the tax returns yourself, in working out what exactly what impacts having all these overseas investments might have on your final tax position. So if we move away from the individual side and we go, okay, well, how do we want to invest? Instead, maybe looking turning left again and going down the pooled fund option, or let's say a managed fund, as opposed to the individual shares. So look, the pros there, obviously very simple to administer. Most of the time, there's you choose a handful of managed funds, international managed funds. There's plenty of them out there, and you really only have the brokerage costs associated to that one transaction. So a couple of purchases to get broad exposure, which isn't a bad idea. And then obviously then having the simple tax or simpler tax situation where at the end of the year, a lot of the tax implications are worked out inside of the fund and then just sort of passed to you. So I guess the other side of the coin, of course, is the cost of management and working out exactly, and we'll talk about the costs in the next slide, working out whether or not you're getting a good deal, essentially. Of course, the low transparency that you typically find with managed funds. Now, this might not be a problem for everybody, but certainly it is harder to get the really the visibility in what's inside of your fund outside of maybe the top 10 or 20 biggest holdings. Very little control. Once again, that may not be a problem if you're paying somebody to manage your money for you. Of course, you're happy to hand over that control. But I guess whilst you're handing over that control, you do need to be sure that you've got adequate visibility about what's happening with the manager and making sure that there is very clear lines of communication coming from managers. I think that's just simply common sense, really, isn't it? When someone's investing on your behalf. And the final one, which is a little bit less known, is obviously the potential for surprises that can arise inside of the fund when you're buying into it. So sometimes there is accrued tax liabilities and costs that may or may not be reflected on the day in the price that you pay for a managed any sort of managed account or managed fund price. And that may not materialise for a number of months, or 6 to 12 months whilst you're in there as well. Doesn't always happen, but it's obviously a pretty nasty surprise if it does. Spoke before about the costs, so this is just a pretty broad view of some of the average sort of fees that are out there in the market at the moment. They've certainly, I think, come down a lot over the years. There's been quite a lot of price pressure on on managed investments in general. Active international, as we've been speaking a lot about today, is particularly large cap international shares. You sort of see around about the 1.5% mark. They can be cheaper. They can also be substantially higher. From an interesting thing there as well, there was the second column is the passive style. So this is where you might find a collection or a portfolio of exchange traded funds, as Damien was speaking about earlier, that are actually that do have an auspice of management over the top of them. So people are still choosing those ETFs and taking a fee. And obviously ETFs are naturally thought to be a pretty cheap way of entering the market. But once you've added in that management fee, you find it's still potentially cheaper than a fully active individual stock portfolio, but not surprisingly cheaper. So, and finally, there with the exchange traded funds, you can see in comparison to the active side, quite cheap, but at the same time, as Damien was discussing, they're useful, but you need to make sure that you've got the right one. The next, the final little piece here I'll just run through is another option that's not as commonly known, called a managed account. And essentially what a managed account is it gives people the ability to still have that portfolio of individually owned shares. But there is then the layer of management on top that makes sure that the asset allocations are right and the stock selection is good as well. And look, one of the big things with managed accounts, and they go by a number of names, IMAs, individually managed accounts, and also SMAs, which are separately managed accounts. At the end of the day, they do still give clients a very high amount of transparency in what they hold. And they do have lower brokerage or transaction costs, particularly the separately managed accounts. And one of the reasons for that is because we have the ability to group trades. So when we go to market with for clients, then we rather than going direct one-to-one for a client into market, we typically will group up, say, a purchase like Google, and we'll go to market once for a larger amount, and then be able to divide that through our client base. From a tax situation, the reports are done by the provider, by the separately managed account provider, and issued out much the same as you'd find an online broker's tax statements at the end of the year as well. On the con side of managed accounts, I guess there is still a cost of management. There is a platform cost that you'll find isn't generally well. In my terms, it's worth the price of admission for the benefits that you get of having the individual ownership. But you do need to be careful that some platforms do have higher trading costs, and also that with smaller balances, particularly the sub 250K range, that they can be quite expensive in comparison to other means. So it's always worthwhile, I guess, making some, doing some research on the various options and making sure that things like managed accounts are right for you. The tax reporting can be a little bit more complicated than a managed fund due to the fact that you do own the individual stocks, but largely a lot of that is condensed down. That makes it very easy for say an accountant to read and put together your tax affairs. So finally, just a run through of what we do. So as I mentioned, we use a separately managed account. We've chosen a platform provider called Linear here in Melbourne. Our cash management is done through the ANZ Bank, and that's an account that sits inside of our platform. And finally, all on-market assets are secured by JP Morgan as the asset custodian. So there's obviously some big names in there, and look, from my experience, it's the gold standard to have it set up like this in terms of risk management for clients. Just quickly on the fee, so we charge 64 basis points, or 0.64% on all asset classes that we manage, and that covers all the stock selection, asset allocation as required. The linear platform fee can vary between 25 and 45 basis points. And because we can group these trades, we can typically get brokerage down to around $300 if we were going to invest $100,000, as mentioned before, with a portfolio. But rather than 20 stocks, you'd be getting about 70 stocks for that $300. So it's definitely at the sharper end of the curve. The other really important thing here is that any additional money for us, so rather than having this fixed brokerage problem, we charge it on the amount that's invested. So on $1,000, for example, if we use that, you'd be paying $2.20 as typically as a brokerage cost. So it does make it a lot easier to add to your investment going forward, and also to rebalance. So thanks very much for your attention there, and I'm not sure if we've got any questions. I'll just look over to our. We haven't got any questions at the moment. I've got one here. All right, let's have a quick look. So what are the costs of non-US stocks? And I guess we'll hand that over to Damien. Okay.
Yeah, look, non-US stocks are going to they're definitely more expensive than what you see from the so Tim showed you a few charts of the US stocks. Most places you're paying at least $40 for a trade in terms of non-US stocks. You also have to worry about some stamp duties in some different countries, and particularly in Asia, they have some things about odd lots. So you have to buy like an even number, like a 10 multiples of 10 or things like that, and you can have some quite high trading costs. So yeah, it is worth noting that if you're looking to do the rebalancing of your own portfolio, if you're sort of doing it yourself within Asian stocks, it can get quite expensive to do smaller transactions.
Okay, very good. And I'll just have a quick look. We've got one more question here. What are the capital gains tax implications for international stocks? So, look, a couple of things there, I guess. That one of the things you've got to be a little bit careful of is the tax status of the country that you're basically investing in. So there are, a series of they call double tax treaties that are set up with most major countries in the world. And it may need to look at it's sort of something that you may need to be a little bit careful of, and it does add a degree of complexity through, particularly if you are investing individually. That obviously the accountant knows that either tax has been paid in the other country, and there may be a credit associated for that. But conversely, you may need to fill out things like there's quite a common form called a W8BEN form, BEN form. Which does state or declare that you aren't affiliated or a US tax citizen as well. Otherwise, you may find there are some US tax holdings or US tax withheld as well that you may need to claim back. So, look, it is something that's worth investigating, I guess, if you are looking at investing overseas. And we can leave it at that. But feel free to be in touch if you need to speak more about that one. One last one here. So there's a minimum balance for do-it-yourself international investing to make it worthwhile. Okay. Do you want me to take this, or you take? Okay, I'll take this one. Thanks, Damien. So look, I guess the minimum balance, well, it really comes down to the size of your portfolio, really, doesn't it? So and reflective, of course, on the amount of brokerage that you're paying. So if you're paying $50 a stock for brokerage, then it's you're probably going to need substantially more to make to fight against the headwind of just onboarding yourself into a portfolio. It really is for most. Well, if we draw it back to Nucleus, so with our international portfolios, we do aim to have around about $1,000 as a starting amount per parcel, and that's the reason why for our direct what's called core international model that we run, there is a minimum investment amount of 70,000. If you were looking, and look, that being said, one of the big problems there is, if you think about the price of Google at the moment, we need to make sure you at least get one share. Outside of that, though, well, and going back to what we do, we have a foundation account which is 35,000, which is the minimum balance to start that one off. It's a tactical fund, so it contains cash, bonds, international and Australian equities. However, for the international component, the all-important international component, we've chosen to use ETFs for that, and we've got a basket of ETFs that are still researched and I guess chosen given the macroeconomic themes, but at the same time, keeps our brokerage down for clients and makes sure we've got meaningful trade parcels. Very good. And just okay, one last question here. What's the process of engaging Nucleus? Thanks for that question. Look, simply put, you can check out our website, which is nucleuswealth, all one word.com. It's in the comments, I think, of the video today, the webinar today. And there's a couple of different ways. We've got a 1300 number, which is 1300 682 623 863. Beg your pardon. And also you can log into our portal, which is if you go to nucleuswealth.com, in the bottom corner there's a little blue bar that comes up where you can put some details in, and that will kick you off into our what's called our portal.nucleuswealth.com. In there, you can check out a number of different things. We are predominantly we're online. We're also obviously available through the 1300 number, or you can email me at tim@nucleuswealth.com. But I normally recommend people to check out the portal first. It gives you a pretty broad view of sort of what we do. Gives you access to the ethical screens. that we have. We've got 19 different ethical screens you can apply to your portfolio, but also gives you a bit of a run through the various ways of engaging us. So you can either choose your own portfolios or go down a space that runs you down through a limited advice piece, which we sort of discuss your various risk profile and attitudes towards risk and time frame for investing, to give you some help there as well in working with us. But feel free to be in touch. Great question. All right, with no further ado, I'll just quickly move to our last slide, and for those watching, we'll zap out a quick 6-question survey. And one of the important questions there is actually what sort of topics, outside of obviously some reflections on today. There's been a couple of hiccups at the start that I'm expected to hear about, but if you'd like, certainly please give us a bit of guidance on what you'd like to have as potentially the next webinar that we put together. There's a couple of little themes there that we thought may be relevant, but feel free to put something in the other as well. And we're more than happy to put something together and come back to you. So with that, thank you very much for your attendance. And yeah, we look forward to speaking with you soon. Cheers.